if instead of funding a whole life policy, you simply bought the cheaper term policy and invested the $920 a month yourself in a retirement or brokerage account that you control? Here's what would happen. See, the problem with whole life is this. It's a complicated and expensive solution to a problem that actually has a much simpler and less expensive answer. It's commonly accepted that money invested in the S&P 500 index over the long term grows at 8% a year on average. I've done exactly this myself throughout my life, and I've done better than this in my accounts over the last 25 years. So if you invest $920 a month, starting at the age of 30 until the age of 60, which is when your term life insurance policy would cancel, how much money would you have by then? If you invested it yourself, would it be anywhere near the $1 million that a whole life policy guarantees you? Well, after just 20 years, when you're 50, you'll have accumulated more than $500,000 in an account that you control. So what about after 30 years? If you were to take the money that you would have invested in your whole life policy, invested it yourself from the age of 30 to 60, after those 30 years, you would have, drum roll please, that's a really bad drum roll, $1.3 million. It will have grown to 1.3 million and change, and you don't need to die to have it. It's already yours. It's been yours all along. It's been growing and compounding in your account the entire time. It doesn't belong to an insurance company until you die. It belongs to you right now. But the whole life policy will pay you $1 million if you die at the age of 80, right? How much money would be in your account if you just invested it yourself until 80 and didn't even bother with whole life? Is it a lot more than $1 million? Hell yeah, it is. $7.3 million, and you don't have to die to get it. So,
okay. All right, so kind of a lot to break down there. So first off, I don't have an issue with people investing in the market. In fact, you could do both if you wanted to. My good friend and mentor Caleb Gilliams wrote a book called The And Asset. If you guys haven't read that book, absolutely read it. It is incredible, and it talks about the compound and control side of dividend paying whole life insurance and how you can do it's called the And Asset for a reason, because you can do it doesn't have to be one or the other. Like, it doesn't have to be whole life insurance or I invest in the market. You could actually do both if you wanted to. And then another mentor of mine, Tom Wall, wrote a book called Permission to Spend. And he talks about how dividend paying whole life insurance, because it's very comparable to bonds and arguably a superior alternative to bonds. What that means is that it doesn't have to impact your stock market investments. What you could actually do is just reallocate the bond portfolio, some of it anyways, to a dividend paying whole life insurance policy instead, because you're going to get so many more benefits in a whole life policy versus just traditional bonds. Right. So why not at least consider that? Right. It's not financial advice, and just putting things out there, guys, as I understand them and how I've learned about them. All right. So this idea that you have to you can only do one or the other. No, whole life insurance is an and asset, guys. It provides a lot of flexibility, a lot of options in our lives to do multiple things at once. Part of it is because of that cash value aspect where we're able to borrow against it, our policy. Our cash value continues to grow, but we can use that money now to make investments. Let me give you an example here, guys. I'm not a huge fan of the speculation play of the market where, like, he's talking about an 8% average, and I'm sure he's done that. Okay. How do you know that's going to continue? Number one, like, we don't know what the market's going to do. If you look at 50 to 100 years. Okay, this is what the market averages over time. But a lot of the times people aren't exposed to the market for that long, especially when they need to start using the money. It's not like we're buying and holding this forever and never doing anything with it. We need to buy it, hold it, and then eventually use it, right, to translate into income, et cetera, right? The other thing is you don't know, like, how do you know there's not going to be another lost decade like we had between 2000 and 2010, where there are two major crashes, took forever for the market to come back? How do you know that's not going to happen at some point during your wealth building journey, or and like, what's the lost opportunity cost of that? And then how do you know it's not going to happen when you retire as well? Can you imagine your portfolio tanking 20, 30, 40%, in 1 or 2 years? I mean, that's happened before. You're saying it can't happen again? Who knows, right? That's the point. Now, I'm not saying not to invest in the market. I'm just not a big fan of the speculation play because we don't know what the market's actually going to do. All right. So the example I like to give with this to demonstrate how whole life insurance is an asset, we don't have to sacrifice stock market investments or whatever investments you're making in order to have whole life insurance. Well, one of the things that I'm a big fan of right now are what's called high income ETFs. I've done lots of videos on this. SPYI, I think, is a really good one. But basically what they do is instead of just speculating on the the appreciation of the market. It's actually generating income right now. It currently yields around 12% because it implements a covered call strategy. Okay. But here's the example is, what if instead of let's say, using what I do right now for this, I put $7,000 per year into my Roth IRA because I don't want to mess with predict what taxes are going to be. I just want to get it over with. Okay. So $7,000 a year into a Roth IRA. And then I purchase SPYI, the high income ETF. All right. And it's yielding roughly around 12%. Okay. Well, what I could do is, instead of putting that $7,000 immediately into the Roth IRA, what I could do is put that into my whole life policy first, borrow against it, and then purchase the high income ETF, whatever that is for you. Okay. And now what's happening is I have my whole life policy, which again is something I can eventually pay off. I don't have to pay into my entire life. All right. I'm going to get all these lifelong benefits over the long run. Okay. Cash value is growing tax-free in the policy. So I'm building wealth in two places at once. So I've got my high income ETF. I've got my whole life policy compounding, providing all these benefits. All it costs me is a little bit of simple interest on the policy loan. And how do we deal with that? Well, if I'm going to put $7,000 a year into my Roth IRA to buy the high income ETF, well, then instead of, again, putting it into the ETF immediately, I put it into the policy, borrow against it. I have this policy loan. All I'm doing is I'm paying back the policy loan with the $7,000 that I would normally put directly into the ETF. And then next year, when I'm able to put another $7,000 into my Roth IRA, I just borrow it out again. And I just repeat the process. Again, the only thing it costs me is the little bit of simple interest on the policy loan. That's it. But the question I like to ask is that worth getting compound interest for the rest of your life? Is it worth having all of these benefits? I would say absolutely. Another example with like the policy loan interest, right? That's what people get hung up on sometimes. It's like, I have a software in my business that I pay $500 a month for. One software. Okay. Now, if I stop there, you probably think, well, that's crazy. Why on earth would you pay $500 a month for one piece of software? Except then if I tell you that that software allows me to make $10,000 a month, now all of a sudden that $500 a month is worth it, isn't it? Of course it is. Okay. Well, it's the same thing with policy loan interest, guys. That interest that we're paying is more than worth it to get that uninterrupted compound growth in the policy, be able to acquire income producing assets and build wealth in multiple places at once, plus all the other benefits, right? So I guess to bring this full circle, my point is it doesn't have to be either or. You don't have to do whole life insurance, but then sacrifice investments. Okay. You can do both. You just have to understand how these products actually work, right? So let's continue.
Oh, if you live that long, the whole life insurance company makes out pretty damn well, doesn't it? They only pay you $1 million. You could have made 6 million more had you invested the money yourself. And that's exactly.
Okay. That was another thing I was going to bring up. $7.3 million. Like, okay. The other problem with buy term and invest the difference is most people don't buy term and invest the difference. They buy term and spend the difference. Whereas a whole life policy, one of the benefits is it's kind of like a forced savings account almost. It's life insurance. Okay. But when you have that annual premium that you have to make, otherwise you could lapse the policy. Okay. Well, now it's forcing you to save money here. And I say save money because when you make those premium payments and as the cash value grows, you have that cash value, you can access it whenever you need it for whatever reason. Okay. So it's kind of like a forced savings vehicle versus buy term and invest the difference. I mean, you better make sure that you're actually investing the difference. A lot of people don't. I'm not really sure where the $7.3 million is coming from. Maybe he's going to do a breakdown of that. I don't know. But those types of numbers, average rate of return can be pretty misleading, guys. I've done videos on this as well. This is not to say that investing in the market is bad and that you won't get good average rates of return. We don't really know. And throwing out numbers like $7.3 million, like where are you getting that from? How much do you have to contribute to the plan, the asset in order to do that? And is that pre-tax? Is it post-tax? Because those taxes are going to eat up a huge portion of that balance, that portfolio balance as well. And then one other thing, he's talking about this $1 million death benefit. What he's not mentioning is that your death benefit grows over time. Maybe he's talking about like what you eventually get to is $1 million. Again, it depends on how much you put into the policy, but the cash value and the death benefit in these policies is continuing to grow for the rest of your life. So, just some important distinctions to make there.
what the insurance company did with your money. The whole life insurance company will make that difference as their profit. Pretty damn nice, right? Why the massive difference? Easy. Whole life insurance is a huge moneymaker for the companies that sell it and for the salesmen involved that look like this guy. No offense. On top of that absurdly massive gap, it has massively high commissions.
Here we go.
Most sources I checked said the commissions on a whole life insurance policy was the equivalent of 1 year of premiums. In the case of what we're talking about today, that would be an $11,000 commissions. Damn, I'm in the wrong business. Why am I?
Okay, so let's talk about that. Can there be very high commissions in when selling whole life insurance? Absolutely. But I'll tell you what, when you set them up for a high cash value, the commission is drastically reduced. We're talking about 50 to 80% cuts, sometimes 90% cuts in the commission that the agent gets. The reason is, so when you're designing a policy, there's really two primary places you put them, you allocate the money to. It's base premium, which is where the agent gets the majority of their commission from. And it's oftentimes the equivalent of 1 year's premium, depending on, well, not 1 year's premium. Again, it's all based on the base premium. Okay, whatever that is, that's where the primary amount of commission comes from, and it depends on what their commission rate is as well. That could range between, I don't know, 50 to 90% or whatever of the base premium. Okay, so the other place that you can allocate money in a whole life policy is what's called paid up additions. That's what provides the high cash value in a policy. Agents typically only make like 1 to 2% of whatever that amount is. It's not much. Okay, so when we're lowering base premium and increasing paid up additions, what's happening to the commission? It's being drastically reduced. Now, if you have an agent that sets up a very high base premium policy and low cash value for the client, okay, that's where the moral hazard starts to come in with these types of products, is the agent is not incentivized financially to set up the best type of policy, the most efficient policy for the client. So it really comes down to who you're working with. Do they know what they're doing? And are they actually going to lower that base premium, increase paid up additions so that you get the high cash value? That's how I set my policies up. That's how we set policies up for our clients. I've actually met people, unfortunately, that the agent either just didn't know what they were doing, or who knows, maybe they were a slimy salesman. They set up basically 100% base premium policy. There was very little cash value in it. It's not what the client wanted at all. And the agent got a huge commission. So this is where him and I would actually agree a little bit. This is one of the things you have to be careful with. That doesn't make whole life insurance a scam. It just means you're working with the wrong person. They should be lowering base premium, increasing paid up additions. That significantly reduces the commission for the agent.